The Headless Horseman here. It's November 9th, 2023. In this video I'll discuss a few news items mostly. First of all, thanks to my sponsors. Let's see here, market is down, dollar down. I think there was some auction of bonds that kinda made things volatile. Gold not too far off from 2000, silver's hanging in there, I was gonna say. But again, I don't really follow the macro news. I don't look at metals too often right now because it really doesn't matter. I mean, when you see stuff that's again trading like gold was at 1400 or 1500 or something, it's like, who cares if it's up 1% or down 1%? If it's up 1%, well, typically people get bullish and then the next day it's red. So I mean, if you act on it that way, it's like, you buy when it's high or when you're in the mood and everybody else is in the mood. Next day happens to be a red day for metals and all of a sudden people are in the mood to sell. So you just bought high, sold a bit lower. And when it comes to project value, who cares? It's like, doesn't matter at all. Again, if something is dirt cheap, it's not going to become expensive because gold is up on a day, and it's not going to, and it's still obviously going to be cheap if it's down. It's just got cheaper, so it's a non-issue really. It's like, again, that's what I think is holding typically people back, at least at extremes. They're trying to guess where the metals are going or whatever, and they don't even care about the fundamentals, because if people cared about the fundamentals, we wouldn't be able to legally steal some of the best projects around at these prices. It's just absolutely ridiculous. They're trading like there won't be a gold mining sector or a silver mining sector, whereas the reality is that every single operating mine is getting closer to its end. I mean, finite resources. That's the thing. It's like, that's why it's also a cyclical sector, but that's what we tend to forget. One point I made 100 times before, and will keep pointing out until this bear dies. All bears eventually die. That's it. That's the law of the markets. There has never been a bear that did not die and turn into a bull, and there was no bull that went on forever and never saw a bear market. Every single day we're not in a bull and still in a bear is one day closer by definition to the next bull. By definition. We know it's 100% certainty the juniors will enter a new bull market at some point. And we know again what happens when the juniors enter a bull market, especially when they're extremely cheap on the offset. So if it's very, very low and we enter a bull market, prices typically go up hundreds and hundreds of percent. What the hell? Hundreds and hundreds of percent. That's why it's like the name of the game is to be here when if you want to catch the big move, you got to be in somewhere around the bottom at least. You can't buy when the bull is halfway over, and the thing is that we know the bull has started like 6 months after it started. That's the problem. So you can't really, everybody tries to time it. It's like, yeah, I'm gonna enter this sector when the bull starts or something like that. When we're in a bull market, everybody says that. Everybody's thinking like that. So how come not everyone is rich? Because it sounds very simple. Oh, I'm just gonna enter and buy when we're in a bull or whatever. It's like, that's known long after. And if there's a false start, you're gonna buy high, sell low. If it's 2 false starts, you're gonna buy high and sell low twice. That can really erode your portfolio quickly. So again, there's a lot of stuff, and the funny part I find is that people keep saying stuff like that, without any regard to their own track record. I mean, again, theoretically it sounds great. I'll just buy the low and sell the high. But everybody's trying to do that. Almost everybody's a market timer and a momentum trader. How many actually make any money? No, because it's almost impossible to do. Just buying around the lows and maybe selling around the highs, that's a lot easier. So let's look at some news. Pacific Ridge intersects 130 meters of 0.48% copper equivalent or 0.71 grams per ton gold equivalent. I mean, there's not a lot of love for Pacific Ridge lately. I mean, it's not the splashy headline numbers like the first hole out of Hercules, for example. But this is a system that's obviously growing. And is this gonna be a mine? I don't know. They have a bunch of land, they have a bunch of projects, they have an earning with Antofagasta at 20 million market cap or whatever it is. It's certainly not cheap. It's certainly pricing in no chance in hell that Antofagasta is going to find something that's going to be a mine, or that Clayul will be a mine, or anything else for that matter that the company has. So we know it's cheap. What the chance of success of actually this becoming a significant mine, I don't know. If we would go into a copper bull and this system keeps growing, could it go up hundreds of % or 1,000? Yeah, I think so. So it's like the best offense and defense is buying cheap. That's it. If you buy cheap enough, you need to be right maybe once every 10 or 20 cases. Or I should say look right. Because it's not like if we make money, was it a good buy? It's like, who knows? We made money. That's what we see. It's like I said before, I can be all in with 2-7 offsuit versus aces, and I win. Does that make it a good all in? Was it a good bet? No, but I won. So unfortunately we can't just look at the results and then in hindsight claim, oh, it was a good buy or a bad buy. No, we just see what happens, and nobody actually knows the odds at any point in time. It's really not about that. It's like I've been bullish on many stocks, and what I think for good reasons, but I lost money on them, and I made money on stocks that in hindsight is like I wouldn't be buying them today, for example, but I made money on them. Were those good buys simply because I made money? Well, I mean, if you make money on what is really a crappy company, if you just assume, well, okay, I just, closed my eyes, bought some hot tip from some pump or whatever, I made money on it, at least for a while. It's like, how much did you learn? Can you reproduce that? Maybe it was extremely lucky. Maybe you actually bought it pretty expensive. You bought it at a price where it's like you need, 50%. It's pricing in a 50% chance of them finding something significant or whatever. And they end up finding something significant. But that's not, typically it's very hard to find something significant. So maybe you were paid a lot when you think about it, but you still made money. So it's like, is Pacific Ridge and Clayul a category killer? No, I wouldn't say so. Do I think it's cheap? Would I be totally surprised to, or I should say, it's one of those kind of binary things. Well, it's not only binary, but it's like if we go into a copper bull, every copper company probably is going to do well. So you have that, just a sentiment change, and we know there's certainly not a good sentiment in copper juniors right now, so we got that going for us. If this company is still around, which I assume it will be for quite some time, and it's not diluted to hell. It's like there are no guarantees of that, and we don't know exactly when a copper bull might start. Might be a year from now, 2 months from now, or 2 years from now. We don't know that, but that's good to have in the back pocket. And of course, if this keeps growing or they're finding high grade mineralization, maybe things change quickly and all of a sudden from out of nowhere, the game is on. It's like, well, this actually looks like a category killing system or whatever. Everything could change overnight. I mean, that's the thing. And of course, the cheaper you buy, the more upside you leave yourself. You leave yourself more rope, because the cheaper you buy, or yeah, I mean, look at it like this: if something or some junior becomes a big success. Okay, I mean, it would obviously matter if depending on sentiment levels, maybe it was trading at 100 million if sentiment was good, and 20 million when sentiment was bad, and you know the end point is 2 billion. Obviously, you made a lot of more money if you bought it at 20 million, and you can afford a lot more losers if you bought the winner that cheap. So that's, again, our best offense and defense is just pay as little as possible for all the assets of a company. All the upside goes up, obviously. Then we have Barrick invests in Hercules Silver, and I've been asked about Hercules Silver. So far it's been going very well, and of course Barrick Gold investing, that's like, you know, I mean, second largest gold company in the world, who are also turning to copper. And I think this is a good point, well, to follow up on the last video I think I did on Hercules Silver, where it's like, at face value, yeah, they announced a good hole, but it was the context of the hole. And I won't go through all the context, I did that in the last video I did on Hercules Silver. But it's like, we're still only one official hole in, and now we even got Barrick Gold coming in. Obviously, they're not buying into every single junior that drills a copper hole with those grades. What was it, 85 meters of 0.84% copper or something? Obviously not, because there are systems, known juniors, whatever, where a company can certainly replicate that kind of result. But it was the context. So if you appreciated that very quickly, one would have been front running, first of all, the nice rise in the share price, and also Barrick Gold coming in at $1.1 per share. So again, that's what I talked about in the last video I did on Hercules. A big edge, let's say, is like to understand the context, or what is valuable. It's not the assays per se in that news release that was most important. It was the context tied to that news release. It wasn't like you just saw the assay results, it's like buy. No, it was the context. So if you understood how important the context was and how it relates to the good drill hole, all of a sudden you would be front running stuff like this. You were front running Barrick Gold. And people have asked me, it's like, okay, what am I doing? You know, and you can see in the forums, I bet I haven't looked today. I bet there's a lot of chatter. I mean, you know, quite a lot of 44 people online. Yeah, a lot of people talking about it, which is kind of typical. It's like, and my position has grown a lot. I took a kind of a snowline type sized position, so I'm up a decent amount, and of course the warrants I have are up. I mean, that's a 10 bagger basically already. I don't mind that at all, but it's like, and despite the fact that yes, I'm up a lot on Hercules Silver, it's grown to a very large position, I don't feel the need to check the share price every minute, post a lot in the forum, whatever, because when you think about it, and you see this debate about pump and dumps and all that. Well, first of all, Barrick got involved, so we know. I mean, if we thought that, hey, or if you think, hey, I think there's pretty good potential in Hercules Silver. Well, Barrick says you're probably right, that there's potential. It's not like it's a guarantee because Barrick is getting involved, but we know, again, the context. What does it mean? Signal value. We want all the help we can get, let's say. We know Barrick has probably some of the best geologists in the world. Okay, we know they probably did a lot of due diligence. So if they're investing at $1.1 right now, we know as late as at least November 6, Barrick believes there's good potential in Hercules silver. And they bought it at $1.1. So it's like you're not buying at 1.1 if you think you're overpaying, obviously, because, I mean, Mark Bristow, he's kind of, I think, known to be a pretty hard driver when it comes to, you know, he wants to make sure you're not overpaying for anything. That's good. I mean, it's a very, I would say, picky company, because it's under Bristow. It's, with that said, it's not a huge amount. It's not like, you know, they're bankrupting themselves, or if things would go south, they're not betting the entire future of the company. But still, again, after one hole, and like someone pointed out in the forum, it's like, I think someone said that, you know, they've never seen Barrick enter a company after only one hole, or the, you know, he doesn't remember the last time. Maybe that's true. And again, that just speaks to what incredible context there is around the hole. Where it was located, it was the first hole ever drilled there, the size of the anomaly, the jurisdiction, the fact that they have, you know, pretty good in terms of their permit situation and all that. All of those things are like value added, or says something about the risk reward. It's like, okay, if you hit it on the first hole, what does that say about the system and all that? And anyway, so now we have a lot of, you know, we got bulls, we got bears, we got bashers, we got pumpers, etc., etc. So what am I doing? Is like, let's just think about this. What we know is that Barrick just, as fresh as a couple of days ago, said that we think this looks like it has major potential. A potential worthy of a major. And obviously the current market cap is not pricing in a project that a major is interested in. So we know there's upside. Because if Barrick's, or the potential Barrick sees materializes over the next 1-2 years, for example, we should get closer to the valuation of a project worthy of a major. And I wouldn't rule out 1-2, I mean, depending on, I mean, if it's a really huge system, maybe, you know, several billions. You know, if it's another Bingham Canyon or whatever. But it's like, we certainly, by definition, if Barrick gets involved, then we believe that they at least want to see $2 billion potential, or $1 billion at $1 billion potential. This is undiluted, but then we get a 5x potentially. So it's pricing in 20% of finding something worth $1 billion, and 10% of something being worth $2 billion. Is that fair? Is it cheap? Is it expensive? I don't think it's expensive, and we know there's upside. Because again, this is not priced yet, not even close to a Barrick-sized project. So that's good. It's like, okay, we're talking upside. Barrick sees this as, you know, $1 billion upside from here, because they think it's a project that could be worth their time. That's great. What the odds are, nobody on earth knows. We don't know what the next 24 drill results news release is going to show. They might miss one, they might hit one, we don't know. We can only make bets. And of course, like I just talked about, we would of course rather at this stage pay 200 million than 400 million. Because 400 million, we need to up our probabilities by 100%, because it's not pricing in 10% chance of 2 billion anymore. It's pricing in a 20% chance of something worth 2 billion. We want to, again, pay as little as possible with the most amount of upside and leave ourselves a lot of room to be wrong. So one could say that, okay, if it's 10x upside potential from here, if we bought 10 different Hercules silver companies, we would need to be right on one. to have our portfolio be net neutral, and that's assuming the other 9 Hercules silvers went to zero. Typically they might go down 50%, whatever, because we know they have a silver resource. But also one thing to keep in mind, of course, from a risk reward perspective, is that if we believe right now that the value, the market value of the silver resource is 60 million, for example, we're paying 140 million speculation premium for the copper potential. If they didn't have the silver, there would be no margin of safety, really. They would only have one copper hole. So it is, and of course, I mean, if the market cap right now would have been 70 million, you're paying 10 million in speculation premium on the copper itself. 10 billion for a project that Barrick deems has $2 billion potential. I mean, obviously the risk reward would be absolutely obscene in that case. Now we're pricing in, let's say, 140 million of the copper target. And, let's say we have 60% downside if the copper thing turns into absolutely nothing. What's the odds of that? I don't know. But still, I mean, right now, even if it became a decent copper deposit, maybe not Barrick size, but it's like, they find some more than high grade, super gene blanket. Maybe the risks are lower than it seems, I was going to say. No, but think of it, if you follow my meaning, what I mean by that is that Snowline, for example, we know that project is, or the Rogue project, very remote, no infrastructure. The critical threshold for success, they need a tier 1 deposit pretty much. Because if they found 2 million ounces at 1 gram per ton, that's like a technical failure, because nobody's going to spend the money to build the infrastructure. Whereas if they drilled 1 million ounces in Nevada, oxide gold at 0.6 grams per ton, maybe that would be worth something, because somebody would actually put that into production. Oxide, heap leach, cheap, infrastructure nearby and all that. This is Idaho. It's not that remote. It's on, the permitting situation is pretty good. So I don't know what the lowest threshold for success is or what that would be worth, but obviously we like the fact that they have infrastructure nearby. There's power lines and roads, and the permitting situation looks pretty good. It's in a tier 1 jurisdiction. So you would be happy with less than if this was the very, very most remote parts of Canada. So it's like, I mean, think of it this way. If, again, to take Snowline as an example, I thought, okay, they would probably need 8 million ounces up there. That's a very high threshold. So basically, if you reach 5 million ounces, one could argue that, okay, it's basically a failure. Nobody's gonna build that. In that case, it's like, okay, you need to be sure that, not sure, but it's like, there's got to be a pretty good possibility that they will find 8 million ounces. I mean, they're probably, I think, going to end up with at least 12 million, if I remember Quinton's latest presentation accurately. So I hope, I mean, this is the fun part, I think, and what makes markets. Our job is to think about all possible future scenarios, well, as many as we can at least, and try to come up with some probabilities. And then we, of course, have to, think from a risk perspective. Because, okay, let's say we think there's blue sky potential of 5 million ounces in a gold target. And we think that you need 5 million ounces there for anybody to actually spend time and money on that project. It's like for it to be worth anyone's time. Then then it's very binary. Either you hit the peak of blue sky, kinda, which is 5 million ounces, or you come up with anything shorter than 5 million ounces and it's a technical failure. Whereas if you're in a situation where it's like same stage in terms of exploration stage, and you think, yeah, okay, there's blue sky, top blue sky is 5 million ounces. But I think given the location, whatever, I think 1 million ounces is a technical success. That's going to be worth something to someone. And then it's just degrees. 2 million ounces, you know, larger mid-tier might get involved. At 3 million ounces, you know, let's say again, it would be in Nevada, whatever. Then maybe a major would be involved. And at like 5 million ounces, every single company working in the US around Nevada would be involved, if you know what I mean. In that case, like, it's not binary per se. It's like, okay, if you only need 1 million ounces, that let's say it's a 50% chance that you'll find at least 1 million ounces. That's a pretty good bet. In that case, and if you're not overpaying too much, in that case, it's like there's a 50% chance to have something of tangible value. And then let's say it's a 10% chance that it's going to be 5 million ounces. So let's say 50% chance that you're going to make money, 10% chance you're going to make a 10 bag or more. Whereas if the threshold is 5 million ounces, blue sky needs to materialize for there to be any margin of safety at all, let's say, then there's a 90% chance that you'll end up with a technical failure, because 1 million ounces won't cut it and everybody will know it. 2 million ounces won't cut it and everybody will know it, yada yada. So then you only have 90% you're going to lose money, 10% you're going to get a 10 bagger. Whereas if the critical threshold for success was at 1 million ounces and you think that's at least 50% chance, then it's like 50% chance you're going to make money, 50% chance you're going to lose money, and you still have the 10% 10 bagger potential. From a risk reward perspective, of course, that's totally different. Even though, again, most people miss, I think, stuff like that because they don't think through the context or the scenarios well enough. Well, to make a long story short, it's like I have taken a bit of profits because the position was just getting, I mean, it's really, really big. But it's like, is the run over? I mean, by definition, if Barrick gets in, we know that this is certainly not near any type of theoretical peak, because this is not a Barrick-sized project valuation. What the odds are that it's going to materialize, I don't know. If we think there's 20% chance that it's going to be worth $2 billion, Barrick-sized, then it's 50% undervalued at face value, undiluted though. Then of course it could be huge. It could be worth $3 billion. Again, we don't know stuff like that. So we want to think about, okay, what's the odds that we will lose money? Well, I guess, I mean, the silver story in itself is a nice backup. So maybe let's say, you know, we go into a silver bull or whatever. It's like just a silver project might fetch a value up to 200 million, 300 million, depending on how hyped up the sector is. So theoretically, if, you know, the silver story is a when story, it's like, yeah, we know it's going to go up, or the silver in the ground is going to get revalued with the coming bull. That's a kind of, you know, ace in the hole, so to speak, which kind of, you know, from a long-term perspective reduces the risk considerably. So one has to, again, we want backup plans. That's also from a risk perspective. It's like, theoretically, think like a fund. It's like, okay, if I held this and could never sell or not sell in the first 2-3 years, whatever, or if I couldn't sell or was forced to hold or whatever, what scenarios can play out so that I can enter without taking a big permanent loss or whatever. So there's a bunch of stuff that could happen. The silver sector could start exploding tomorrow. We have no idea. Copper sector could start exploding tomorrow. We have no idea. But at the end of the day, if over the next, I don't know, I mean, and they're probably going to start releasing news anytime soon. So let's say they put out a big hole, 600 meters, so I'm just guessing here, like 0.8% copper or whatever. Then I think this story is going to get jacked up again. So I think that there's emotional consolidation right now and price consolidation. Because so far we had a price run up, and now we have Barrick's vote of confidence, but we don't have any more results. So what's holding people back, of course, it's the fact that we're only one hole deep. But if we have 2 more holes that are good, then we triple the amount of de-risking drill holes. All of a sudden we have now it's a 1D picture, if you know what I mean. 1 more hole, then we get a 2D picture. 3 more holes, 3D picture, kinda. So I think I expect this to maybe go very swingy, and of course then we gotta think like, okay, what are the odds if we're thinking a bit short term here? What are the odds that their coming drill results will be absolutely shite and the story is over? I mean, we have to assume that Barrick has looked at some of the core, and as I understand it, there might, I don't know if it was leaked or whatever, but it's like, yeah, you could kind of tell, I guess, or they could tell in the core from the first hole that it looked good. So we have to assume kinda that Barrick has looked at the core, and as late as November 7, which is 2 days ago, they were happy with how it looked. They believe there's Barrick type potential. So maybe this is a screaming buy still. I'm not 100% sure, but I'm keeping a big position still. But at the same time, we also have to remember that there's the opportunity cost of if questions, exploration risk, is the fact that there's a bunch of advanced explorers and developers out there. They are so cheap that it's mostly a matter of when, not if, they're gonna go up a few 100% at least in the coming bull market. So that's the opportunity cost. That's like the birds in the hand, and here we got maybe 30% of a bird in the hand in the silver, half a bird in the hand, but we need to have positive answers to a series of drill holes for this to turn into, for the birds in the bush to get in the hand and we get our multi-bagger. So this is news driven, whereas a lot of the beta plays, advanced explorers, developers, they're just sentiment driven, and sentiment is cyclical and drill news is not cyclical. If you drill 10 bad holes, it's not gonna there's no like, yeah, you know, after you drill, well, the bad holes are gonna stop going at some point because it's cyclical. No, it's not cyclical. It's an if question. There's no guarantees of anything. We know that sentiment is gonna change. That's a guarantee. Anyway, I don't know if I responded this in a big way, but it's like, the way I would see it is, how much are you comfortable? Again, let's say there's, you know, the downside is 50 to 70%, and the upside is, I don't know, 500 to 1,000%. Have whatever position you're comfortable with, and the best way in reality, which is very hard in practice, it's like almost like I was gonna say, you make your mind up. It's like, okay, whatever position I have, I'm gonna hold that until the position size just becomes too big. I mean, in reality, risk reward, because now, for example, the price might swing with no news. So in a perfectly efficient, or from a perfectly efficient point of view, from a risk reward perspective, price versus value, we should be selling a bit on every uptick and buying more on every downtick, in accordance with the ideal position size would be, in light of the stuff we know. Because if this goes down 10% on no news, it just means we assume there's no leak. It just got the risk reward just got better because there's more upside and less downside. And if it goes up, it's a bit less upside and more downside. So by definition, from a risk reward perspective, that becomes a worst bet. But then the question is, okay, so what is the optimal position size right now? And I don't know. I have way higher exposure right now than anybody would recommend. But then again, I'm all in on juniors all the time, which nobody recommends. So again, I'm not after perfection. I have a pretty big, pretty big bet ongoing right now. And I mean, if Hercules Silver goes up 20% from here, for no other reason than better sentiment, maybe I'll sell some. If it goes down, maybe I'll add back some. Again, value shuffling. It's like I react to the opportunities the market gives me. But it's like to have it only a binary thing, like, okay, I was here for the risk and now I sold everything. I mean, they're one hole in. Barrick just joined. We know there's a big difference from this and what Barrick needs to see. So it's like there might be the 10 bagger journey might be starting. We don't know. We just know this is not a Barrick sized project yet in terms of valuation. We're not pricing in 100% chance of success that Barrick is 100% right. That we do know. So I'm gonna I mean, at 200 million, I'm not too worried about overpaying. I certainly don't think it's a screaming sell at 200 million. Because again, I'm looking at okay, what's left to be priced in, and if Barrick just said it looks good right now at 200 million, then, I mean that should be good enough for me. If things work out, maybe this goes up even more, and maybe it pays for numerous stories that does not pan out, or maybe this does not pan out and we'll need some other junior to pan out. But the thing is that you can't bet on 10 high risk high reward stories where it's like, let's say 10% chance of success from an early stage perspective, and the 1 in 10 that's a success, you sell that after a 50% run up when the 10 bagger journey might be starting. That's not going to pay for 9 other failures. So you have to ride some of these high growth plays long and hard if you're into the high risk, high reward strategy. We can't just take high risk for little reward. That makes no sense. That's why I don't typically like pure pre-discovery plays, because even, and I've said this 1,000 times, let's say there's a 5% chance of a maiden drill campaign making a significant discovery, and you know that, hey, if they make a significant discovery, the immediate price reaction to the upside might be 100%. The immediate price response to the downside, if the 95% risk happens and they don't have a significant discovery, 50% down. What kind of value proposition is that, or a bet proposition? 95% chance that you'll lose 50%, 5% chance you'll gain 100%. That doesn't add up at all. That's a incredibly bad bet. If you do that bet an infinite amount of times, you're gonna have 0.00001% of your position left. I mean, you're gonna annihilate yourself. So that's not a good risk reward proposition. Now we know Barrick is involved, so again we gotta make some assumptions of what chance of success Barrick sees this has to be worth their time, and maybe what is worth their time is something worth 2 billion, for example. In that case, we're pricing in a 10% chance of that. So if it ends up happening, we should get a 10 bagger. If it not ends up happening, we should get a minus 50%. And if, let's say, if we believe there's a 20% chance that it's going to end up being a Barrick type deposit, then the risk-adjusted value today would be 400 million. And it's still cheap in that case. 100% upside to fair value from a risk-adjusted perspective. And the total upside is still obviously 10 bagger. I hope that made some sense. Again, it's like we're not after perfection. We're after good bets. Good bets. Where we don't need to be right all the time. We leave a lot of room for the upside. We leave ourselves a lot of room to be wrong on many stories. Because that's what drives me crazy when I see people bashing other people because they had junior stocks that were down. It's like, in what universe can you expect anyone to have even close to 100% hit rate, especially if we're in the high growth or 10 bagger category? By definition, it means that it's like less than 10%, or let's say 10% of the stocks should work out. If you think that there's a lot of people out there that have, like, I don't know, 80% hit rate on 10 baggers, you're probably crazy. Anyway, right now when everything is cheap, it's even better because you can afford to be wrong on the geology can prove out to be bad more often because you're paying so cheap for these stories, that the ones that end up proving out, they have so much room from whatever valuation. It's like Brixton Metals, for example. Brixton Metals private placement oversubscribed for 14 million. That's good. Now we know. I mean, they can go back and drill the gold project and the copper projects. They didn't get the eye-opening hole yet in this season, which is kind of unfortunate. There was no aha moment, if you know what I mean. We know there's a porphyry there, probably a very big one, but they didn't get a philo type drill hole where everyone's like, Jesus Christ, I've never seen anything like it, kinda. But with 14 million bucks, they get more kicks at the can. So as far as I see it, this story might, again, change very quickly. Because all it takes is kind of one hole. Because, again, BHP is invested. I'm not sure if BHP is actually putting in money in this one. That would be interesting to know. But still, last we heard, where last financing BHP got in, and BHP is the largest mining company on earth. They might need to see more than 2 billion. They might need to see 3-4 billion dollar potential in those projects, and the current market cap of Brixton is 55 million. So it's like, yeah, if there's a 50% chance that they find something worth BHP's time, this is extremely undervalued. If this has 10% chance of ending up well, this might be a extremely good bet, even with only 10% chance. Because if those 10% chance happens, I mean, a 10 bagger is only 550 million. So it's like a 40 bagger to 2 billion, or almost 40 bagger to 2 billion, if you know what I mean. So it's like, but how people are gonna act, or how it works is, if they don't end up finding a BHP, they don't delineate a BHP size price, people will say, yeah, it was a bad bet. I think that's by definition wrong, because if BHP is interested and is pricing in no chance in hell, if BHP thought there was no chance in hell, they wouldn't have put in money, because there's a bunch of juniors out there with no chance in hell to find something, and you don't see BHP investing in every single junior. So I think by definition, it's like, almost by definition, it should be a very good high risk, high reward bet at around these levels, given the context of having BHP involved. Then we have District Metals announces definite agreement with Boliden, and you can watch the interview here with Garrett. Very interesting. It's very cheap. I might have actually talked about this already. Insider buying as well by Garrett, as recent as yesterday. Yeah, I mean, I just discussed District Metals with. No, I didn't mention it on K Report. We ran out of time actually. But still, this is I think a much better company today after the Boliden announcement. Risk gone down, higher chance of upside because they will get around 10 million to spend, I think, and 3 million going to Tom Tebow. Market didn't react, and this is what's supposed to happen in bear markets. The market is dumb as a bag of rocks. Nobody's watching this sector, and the ones that are in this sector, they're probably out of money already. Because it's like, I know from, in my case, for example, if everything was fairly valued or overvalued and this would have happened, I would be piling in so much into District Metals right now. Problem is that there's like 30 stories that I think are absolute no-brainers. And I'm always all in. So you get spread thin, and that's what I think. Because if everybody was like me and saw this current environment as the best buying opportunity since 2015, we wouldn't see these prices. They would stop going down today. But if you look at Twitter and whatever, or talk to your neighbor, obviously they will say, why be in this sector because it's been so shit. Even though, I mean, you know, the hindsight investors, they think they create, they avoid losses by or avoid losses or make money in hindsight. Who cares what has happened? We're interested in where we're going from here. What's the risk reward for the future? This was an interesting news item. Newstar says to suspend operations at 2 US zinc mines. I read another article that zinc prices hit the highest of a month at least, because there was some problems. I think there was a fire in some Chinese refinery or something like that. I mean, it just kind of goes back. This news kind of goes back to, you know, what Rick Rue likes to say. The bear markets are the authors of bull markets. I remember this stuff in 2015. Glencore closed down some of their zinc mines, if I'm not mistaken. So prices got so low in the metals that miners shut down their mines because they were not making any money. What happened then? Supply shrinks. So the same amount of money is bidding on fewer and fewer commodities. What happened? Prices shot right up, and that was the start of the 2016 bull market, when gold also went up. Everything went up because the miners were shutting down operations. Interesting today is that gold prices are doing quite well, even though yes, inflation and all of that is up. But I think the majors are still making money, unlike 2015. Altamira announces closing upsize 6 million private placement. Altamira is also pleased to announce that Aura Minerals has participated in the offering and has now become an insider of the company. Crescat Portfolio Management also participated in the offering based on its preemptive rights. I participated as well. Check the market cap. 22 million Canadian. Today 137 shares traded. This was announced 2 days ago. Yeah, because I don't think Aura was mentioned here. No, okay. So we're 2 days into the Altamira story after they announced that Aura Minerals, which is, I guess you would call it a mid-tier or something. They're a producer in Brazil. They got several mines, or at least planning to have several mines. So it's a serious player, a mining company that knows what they're doing. They know Brazil. They put money into Altamira. 2 days in, nobody gives two craps about the fact that a mid-tier came in and say, hey, we think, you know, this might be a mine. What you have might end up becoming a mine. It's pricing in, well, if you 10x this, it's 220 million. That might be, I was going to say, on the low end of what I would think they would want, or what a mine would be worth to them. So it would be up from, I mean, on an undiluted basis, a 10 bagger would take it to 220 million. That might be something, you know, yeah, okay, that might reflect a small mine. I think there's potential in Altamira for them to have a pretty big and good mine. I'm thinking there's $500 million plus potential, especially if Maria Bonita delivers. Suffice it to say, at 22 million market cap, I'm quite bullish on Altamira. And again, we go over this again. I mean, it will take time. But again, when you think about it, people complaining about, oh, my, the stocks have gone down, or, oh, not every, I'm not in the green on every single company. Where it's like, I mean, let's have some common sense here. From these levels, if Hercules silver turns into a barrick-sized deposit, or finds a barrick-sized deposit, that might be a 10 bagger. Okay, a 10 bagger. That would pay for a lot of other stuff. If Brixton ends up finding something that BHP would mine, that might be a 40 bagger, let's say. Well, okay, just these two alone then. If quote just these two work out and you held them until a buyout or whatever, maybe they will have paid for 50 positions of similar size that went down 50%. But the thing is, how many actually stay for a 10 bagger? People say, I'm after 10 baggers. If it goes to 10, if it goes up 10 times and you sold 95% of your shares along the way, you get a 10 bagger on 5% of your initial capital. That's not going to pay for 50 stocks that went to zero. So we kind of, some of these stores, I think we kind of have to ride hard or let run hard. But of course, it's very tough to, let's say you take a position, pretty decent position, you're up 100%. You stick with it, it goes up 100%, or let's say it goes up 200%. All of a sudden you're in a pretty good profit, but you still think there's upside. But there's obviously risks left. And then, as more news comes out, we find that, okay, this didn't work out. What everyone hoped was there, wasn't there. And you see that profit evaporate. Yeah, that's going to be tough, obviously. The thing is that in order to play the reward side of the risk-reward stories, one kind of has to let some positions run. Otherwise, they will not pay for any other stories. I hope that makes some sense. This is very tricky in reality. Because how comfortable would you be having a huge position in some junior? But if, again, I'm just saying that theoretically here, if I let my current position, if I never sold another share in Hercules silver, if this turns into a barrick-sized discovery, this position alone would like 2 bag, 3 bag my entire net worth. How easy is that to do in reality? To sit and see that amount to, 70% of your entire net worth, one stock. No, that's not easy. That is not easy. That's why I actually kind of prefer against, like, you spread bet, especially the more risk there is. So if you start with, if you have 20 highest high reward stocks, you have 50, even if you have 5% position, I mean, that could quickly turn into a 20% of your portfolio. So it's not super easy again, and that's before. I mean, we're not even getting close to a 10 bagger yet, because then you would double that again, and it would be up to like I mean, closing in on 40% of your net worth. And if the other stories went down, then it's, I mean, then it's not even 40%, then it might be 60, 70%. So it gets kind of crazy if you let these stories run, but at the same time, sometimes you kind of have to force yourself to have the stomach, because like I said earlier, it's like, how on earth are we gonna pay for the high risk portion of these plays if we capture 10% of the reward side of things? It's almost impossible. And that's what I think, or why I think most people lose money, and why I think high risk, high reward investing is very hard. Because, like, let's face it, take Great Bear. That went up, after the discovery hole, that went up like 10 to 20x. How many do you think actually sat on their position the whole time? I think a lot of people took most of their profits after 100, the ones who were in pre-discovery, took most of their profits after 100 to 100% run. So that's what they got out of it. They didn't get a 20 to 30 bagger. They might have gotten a 2-3 bagger. But it's damn hard to ride a huge position and it goes up more and more and more, because you all of a sudden have more paper profits to lose. So it's not easy. It is not easy. That's why I, in some way, shape or form, theoretically it would almost be best that, like the idea behind my gambler portfolio, that you just put on a bunch of bets and then go away a year on some remote island. Don't look at a portfolio, come back. It's like maybe 90% of that portfolio would be made up of 2 stocks at that point in time. But otherwise, it's very hard to get yourself not to sell out too cheap, if you know what I mean, and let the winners really run. Because like we see, the good systems, they tend to get better. And in this case, again, what I'm thinking Hercules Silver is like, the most important news in a news release is not what it says about today, it's what it says about the next 10 to 20 news releases. So if we think we read the Hercules Silver as results and we're like, okay, I think there's all of a sudden a 15% chance that this will turn into a $2 billion story. And it was pricing in a 5% chance of that. Oh my God, it's 200% undervalued. Hit the bid. And then if there's no other news out and it goes up 200%, then you're like, okay, all of a sudden I'm paying fair value. It's not a no-brainer buy anymore. It's actually at fair value. It's not a buy or a sell. If you find something else, it's a sell, because you'll sell that and buy something cheaper. But that's the kind of stuff. So in that case, it makes sense. If there's no news and it totally reprices and includes the scenarios you have in mind, all of a sudden it might be a kind of a sell, or that you should take profits at least. That's why it's like, in my opinion, if you're a quote value focused investor, you don't need to think about timing, market timing or stuff like that, because you're only going to be looking at the price you can buy or sell the company today versus whatever future you think might happen and what the odds of that future happening, and then come up with a fair price today. If it's below that, you buy. That's why it's like when people right now, it's like, how can you still be bullish? Year later you said buy. Yeah, because there's companies out there that have been screaming buys for over a year. That's the way I see it. I mean, and then just to put, other things into perspective. Like I got a lot of high risk, high reward bets out there. This is the short for Tectonic Metals, and they're drilling their flat gold project up in Alaska. I think there's a very high threshold for critical success there, meaning they need to find something really good for that to be of real interest to companies because it's quite remote. Okay, this is the short. Okay, do I know that Tectonic is gonna find, you know, another Valley type deposit or, you know, Donlin Creek type? Absolutely not. But market cap is 46 million or 47 million. It's pricing in, you know, a 10% chance of finding something that's someday is going to be worth 500 million. And a Rogue or Valley type project, I mean, that might be 500 to $3 billion. That's it. It's like, I mean, we're trading pennies in a lot of these high octane, high risk, high reward stories. Who cares if it's at 42 or 48 million or 45 or 50 million or 40 or 55 or whatever? Either they're gonna find something that a major would be interested, or they're not. It's not like, well, from 47 million to 2 billion, that, you know, that's fine, but it's like, I'm not paying 50 million or whatever. No, I mean, those are rounding errors. And that's why I like, you know, huge blue sky potential and pay as little as possible. It's not like it's pricing in no chance in hell, but it's obviously not pricing in that there's a big deposit there. The market is extremely skeptical. I mean, it might be, again, pricing in a 5% chance that they're going to find something like, you know, roguelike or better. And is that fair? Nobody knows. But we're going to get results sooner or later. If this works out, if Tectonic works out, maybe it's going to even, given the starting market cap, maybe it will pay for Hercules silver if that becomes a total failure, and then some. Or maybe both Hercules silver and Tectonic fails, and Altamira will pay for both of them. If 2 out of the 3 work out, maybe I'll make a lot of money. I mean, stuff like that. But it doesn't happen overnight. So it's like, it's almost totally irrelevant if Tectonic is up 10% or down 10%. Because in the grand scheme of things, either they're going to end up finding something big or they're not. If they're not, you're going to lose money, regardless if you paid 50 or 40 million. If they find something big, you're not going to care if you paid 40 or 50 million. But a lot of people are like trading these stocks at these levels. Like, who, in my opinion, who gives a crap? You know, check back in a year or something. Give Tectonic Metals 2 seasons of drilling. If you did nothing but hold the stock, either you're going to be up a lot or you're going to be down a lot. That's it. But most people, they try to time every single move. They get in and they go out, and you know what I mean. They don't even let the case play out because it's quite binary. Again, I think especially in a remote area, either they find something big or they're not. And if they don't find something, it's like, oh, what an idiot I was for buying it or holding it. I mean, how can you say that? Nobody knows what the chance of success was. We know if the market priced in 5% chance, and we know it's actually, if God told us that it was actually 15, we were getting a steal. But that still means 85% chance of failure, and it would still be a steal. And even if the 85% chance of failure materialized, yes, we would lose money, and we would still have made a superb bet. Again, we can't just look at the results and say that, oh, that was a good buy, because no, the only information worth something in hindsight if we can make better decisions in the future. We need to think about the future now and make the bets now. People talk about opportunity cost. They look at share price movements in hindsight and say, oh, you know, opportunity cost. It's like, okay, so tell me what are you going to do with that information? It was like I saw a user on Twitter post a chart of gold miners, I think, relative to gold or something like that. And it's like it had been under a ratio 1 for 8 years, which would be, you know, underperformance. And I just asked, like, yeah, so what conclusions do you draw? And he said, well, that they can be cheap or underperform for a long time. It's like, okay, now we have a firm grasp of the obvious. So what do you do with that information? I mean, it's absolutely worthless information. The funny thing is that before that, it spent 10 years or so above a ratio 1. It's absolutely worthless information. If anything, it tells us that they've underperformed for 8 years. And since it's cyclical, we should be getting more bullish. Not drawing the conclusion that it has sucked and therefore it will suck forever. That's the wrong conclusion, but that's typically what people draw. Anyway, this has gone on for long enough now. I hope you got something out of it. And I was going to say... and I was gonna say, you know, put some comments in the YouTube, on the YouTube video, if there's any questions or topics or whatever. I hope I'll try to, you know, answer as many as I can. And I know that, you know, I get emails and I forget to respond. And it's like, please don't take that personally, because I get so many emails and there's so much news. And even if I, you know, put the email on, you know, a market with a star, whatever, that I'm gonna, you know, revisit. But it's like I get swamped with just emails that I marked with a star as well. So if you have some burning question, whatever, and you haven't gotten a response, like send it again, and please don't make it too long, because it's like it's gonna be hard to, you know, spend 30 minutes responding to emails. So preferably relatively short emails, but yeah, so just let you know, it's like I'm not trying to ignore anyone on purpose. It's just, you know, there's a lot of stuff to do all the time, so I'm just short on time. Yeah, thanks for listening. Consider me biased. This is not investing advice, or this is not a buy or sell recommendation. Anything I talk to, educational purposes, as they say. Some companies are banner sponsors, so consider me twice biased. I think I own almost all the shares I've talked about, if not all. So again, yeah, do your own due diligence. Have a good one. Bye.